Usually, when people are joining the crypto industry, it's because they know someone who bought Pepe on time or got lucky with their investment. And now they're trying to pull as much profit as possible, and unfortunately, usually they opt for the wrong path. In this video, I will give you the exact strategy that you should follow to position yourself for the next bull run. Hello guys, my name is Željko and welcome to Crypto Grid. As you could see, we did some rebranding on the channel since Unsymmetric was pretty much impossible to find due to Google autocorrect that was fixing it to asymmetric. So I'm looking forward to hearing in the comments, do you like the new logo, new style, or if you prefer the old one and why. I also have one friend joining me on Crypto Grid, so I hope to produce both more quality videos with slightly higher frequency as well. So let's go to the subject. Majority of the people dream to get rich via crypto. For some that means getting to 100k, for some it's 1 million, for others it's much more. So today I will keep this video shorter and I'll try to go straight to the point. Why do people fail in achieving these goals? And in the next videos I will address each of the points and maybe add some more to it. So the first thing is having the right mindset. Usually by mindset I mean having realistic expectations in the first place, being aware of what you know and what you don't know, consistently educating yourself and growing, learning from mistakes along the way and improving your strategy without making emotional decisions. This is probably the main reason why people fail actually. When I talk with people I hear so often stories like, I invested in crypto once, $50, $100, and I lost everything. It's because the way how they approach the markets. Usually it's like, how can I turn this $50 into a car or a home? And that's not investing or good strategy, that's gambling, and even they are often aware of it. This leads me to a second point of understanding the markets. There are many aspects of it, and it's not something that you can do overnight. Usually, from what I have seen, and I feel that was my case as well, it takes at least one bull run and one bear market to get some understanding of the markets so that you can make some solid decisions. The longer that you're watching the markets, the higher odds that you acquire some kind of a feeling for it. So, you should be aware of the macroeconomic things such as the CPI index and inflation data, the correlation of DXY index and S&P 500 with the Bitcoin price, events that are happening like Bitcoin halving, potential approval of the spot Bitcoin ETF for example as well. You should be aware of technical analysis and things like support, resistances, trends, various candlestick patterns, indicators, and analyzing charts in general. You should also be aware of on-chain indicators such as an active addresses, stablecoin supply ratio, MAVRV score, and R-HODL ratio, for example. So these are just some of the tools that you can use, but don't be scared, it's not something that you necessarily need to know to start investing. But being familiar with these things and tailoring your strategy along the way with what works for you is one of the important factors for success in the long run in the financial markets. Still, even if you are new, this shouldn't discourage you. Let's say if you're looking to invest $1,000 monthly, you can pretty much invest it every first of the month and you would still be around 2 to 3x in the profit in the long run. As you're learning and improving, you can always adjust the strategy and look on how to outperform DCAing into the markets. Another issue is when people are calculating returns, they often calculate from the bottom of the market to the top. And this will almost never happen in real life situations unless you are really lucky. So when you're buying some asset and entering some position, you should always think of how much lower can the price go. What kind of drawback are you willing to accept? Are you willing to miss the entry if the price goes up? Same applies when you're taking profits and exiting your position. If you're looking to build a long-term portfolio, I would usually suggest you to have 2 to 5 entries and 2 to 5 exits in each of your positions. When you're thinking about in which altcoins to invest, again, I advise you to reconsider the decision because, as I said at the start of the video, in a desire to earn more, people often lose everything or almost everything. If you look at the current landscape, 99% of the altcoins will lose 99% of their value in the next 5 years. So when you're looking to invest in different assets, always look at their performance against Bitcoin, against Ethereum, what's their roadmap team, and analyze them as much as possible, because you don't want to invest in something that has more risk and less potential return than Bitcoin in the long run. Also, you're spending additional time into researching them and managing multiple positions and coins. And if it happens that you invest in something that loses 20%, you need to return 25% to come to the original value. If you lose 50% of your portfolio, you need to gain 200% or 2x to return it. So, besides thinking of earning money, you should always think about capital preservation. Since even the small returns, if you compound them over a long enough time, it will make you rich. This is the path that Jeff Bezos took with Amazon, for example. The investors knew that Amazon won't be profitable for a long time, so they were investing all the money to gain an advantage and be ahead of their competitors in various segments, and they knew that it will pay off to them. So this is why you want to have a good portfolio diversification. I always like to have at least 20 to 30% of the portfolio in Bitcoin and Ethereum, because once the bull market occurs, even if everything else fails, if everything goes to zero or underperforms, you will most likely be at the initial amount of money or even higher, even when you calculate diminishing returns over multiple cycles. So whether you're trading, investing in smaller caps, doing some liquidity providing with high API, or flipping NFTs, I would always have at least 20 to 30% in BTC and Ethereum. I always like to have some stable coins on the side, like 10% or at least a stable inflow of capital from another source, because you never know when the markets will crash and you get an awesome buying opportunity. Regarding the stable inflow, I think this is also one of the biggest mistakes for the people. If you have less than 100k in crypto and you're looking to fully transition to trading, you need to find a good paying job. The less needy for the money that you are, the higher odds that you make good decisions, and this doesn't apply only to crypto and financial markets, it applies to any aspect of life. The good analogy is that when you are in a relationship, more girls become interested in you, but when you're alone and single, each of them pretty much declines you. With the rest of the capital, as I said, if you're new to the markets, you can always DCA. If you are more advanced, whatever you're doing, make sure to transfer some of the profits into the main part of the portfolio, because historically looking, many of the things failed at some point. When I joined crypto space, everyone was looking for good IDOs, and since back then you didn't have vesting periods, people would come in the IDO phase and immediately sell once the project goes public. One of my clients earned a ridiculous amount of money pretty much using mainly this strategy. But if somebody had all his money in this at one point when vesting periods were introduced and the bull market finished, majority of the projects were actually at a lose. And if you would be splitting 30% into the main portfolio during that time, you would still be at a huge profit. The most important thing maybe to address is security. I feel that this one, besides regulations, is one of the biggest obstacles for further crypto adoption. I was also hacked for 40k. I know a lot of people that lost at least some of the money, so the most secure thing that you can do is hold the majority of the assets in the hardware wallet, and the rest of the funds, even if you're holding it on some centralized exchanges or some wallets, make sure to always use 2FA and to spread the money across various platforms. And if you use MetaMask, make sure to connect it with hardware wallet as well, since you need physical press of a button to execute transaction. So for someone to hack you, you would either need to approve it or somebody would need to break in your apartment. I often hear that people wait to get to certain portfolio size before buying hardware wallet, and usually they prolong it even further, while actually this should be the first thing that you're doing in crypto markets, buying hardware wallet at the same time when you're investing your first money in crypto. And no, there isn't a single referral link to hardware wallet in my description. And also, it doesn't matter if you make 10k, 100k, 1 million. If you get hacked and you lose all the funds, you're pretty much starting from the scratch. Anyway, I hope that you liked the video. I'm looking forward to hear what would be your advice to people to thrive in crypto markets and grow their portfolio in the long run. Also, please consider subscribing since that motivates me to make every video better and proves to me that you get something from these videos on your crypto journey as well. Thank you for watching, stay strong and healthy, bye!